You've seen the names Dow Jones, S&P 500, and NASDAQ appear in the news countless times. But what do these terms mean? And why are there three of them? Well, they're not the same thing at all, and they each tell a very different story about the stock market. Hi, I'm Brian Feraldi. I'm a financial educator with more than 20 years of stock investing experience. In this video, I'll explain why we have three major stock market indices, how they're different, and why knowing the difference can make you a fortune. It all started in 1896. That's when Charles Dow, a journalist and co-founder of the Wall Street Journal, was frustrated. His paper printed pages of stock prices every single day, but there was no way for him to sum up what happened in the market. It was just a table full of numbers. So he teamed up with his business partner and statistician friend, Edward Jones, to create a solution. The duo picked 12 well-known companies, most of which were industrial companies, and added up their stock prices. Then they divided the number by 12, since there were 12 companies. This process is called averaging. They called this number the Dow Jones Industrial Average, and they've been reporting it every single day since they invented it in 1896. Now today, we call this idea indexing. It's when you take a sample of stocks and use that to represent the overall stock market. Now over time, the Dow, as it became known, caught on, and it became the go-to benchmark that investors used to judge how the stock market was performing on any given day, week, or even year. Now, as time passed, the economy and the businesses in the Dow changed. Some of those original 12 companies grew, others shrank. Some were acquired, and some went out of business. These changes forced the Dow Jones Industrial Average to adapt. Over time, the Dow expanded from its original 12 companies to 30s. And even today, the list of stocks in the Dow changes ever so often to reflect changes in the economy. Every couple of years, some companies get added to the list while others get removed. Now, the Dow was a fantastic innovation, but it had two major flaws to it. First, the Dow is a price-weighted index. What that means is a $400 stock has 4 times the impact over the Dow than a $100 stock does, even if the $100 stock is a much bigger company. This is a relic of when the Dow was first created. They had to use stock prices to make the calculation as simple as possible. However, the dollar price of a share of stock tells you nothing about the size of the business. The other major flaw was that the Dow only tracks 30 companies, which critics say isn't enough to represent the entire market. Now again, the Dow uses a small sample size because it was originally calculated by hand. So adding in too many companies would make the calculation too overbearing. But despite these two flaws, the Dow became wildly popular with investors and the media and remains one of the most widely quoted indexes to this day. Now let's fast forward to the 1950s. By then, the economy, the market, and technology had all changed drastically. The Dow itself was still useful and highly quoted in the media, but its flaws were beginning to become more obvious. That's when a rival publisher called Standard & Poor's stepped in to take advantage of an opportunity. In 1957, they launched the Standard & Poor's 500, which is more commonly referred to as the S&P 500. Now, technology had advanced enough at this point for the S&P 500 to be able to fix two of the Dow's biggest flaws. First, instead of just tracking 30 stocks, it included 500 of the largest U.S. companies across every sector of the market. Second, unlike the Dow, which used price weighting, the S&P 500 used market capitalization weighting. This means that the biggest companies had the biggest influence over the S&P 500, regardless of the price of a single share of their stock. Now, these upgrades were a huge advantage over the Dow Jones Industrial Average, and slowly over time, the S&P 500 started to steal away mind share with everyday investors. Now, today, the S&P 500 is filled with the largest and most profitable businesses in the world, and most professional investors use the S&P 500 as their primary benchmark. Now, we need to fast forward the clock again, this time to 1971. That's when something brand new arrived, the world's first electronic stock exchange. Now, it was called the National Association of Security Dealers Automated Quotations, or just NASDAQ for short. Unlike the New York Stock Exchange, the NASDAQ had no trading floors. All of the trading was done on computers. The NASDAQ's big innovation was that stock prices were reported electronically. That means they could be kept up to date around the world instantaneously, which allowed investors to stay up to date with stock prices regardless of where they physically were in the world. That was a huge advantage over the New York Stock Exchange, which often had a big delay in stock prices depending on how close you were to the actual trading floor. Now, these benefits were highly attractive for a new wave of tech companies that were just starting to come public. Companies like Microsoft, Intel, and Apple all wanted to be a part of the future, chose to list their stocks on the NASDAQ stock exchange instead of the old school New York Stock Exchange. Now, just like the Dow and S&P 500, the NASDAQ uses an index to report what was happening with stock prices on the NASDAQ that day. However, since the NASDAQ was reporting everything electronically and computers could do all the work and calculations, the NASDAQ Composite Index could use all of the stocks listed on the exchange to quote the index's price. That's why today the NASDAQ is home to more than 3,000 publicly traded stocks, and all of those stocks impact the price of the NASDAQ Composite Index. And the NASDAQ has grown incredibly popular in recent years, and it's become the go-to place for companies that are focused on growth and innovative technologies. As a side note, if you want to learn more about the basics of stock investing, I created a free infographic ebook that contains 10 of my most popular visuals of all time. If you want to download a free copy of that ebook, just visit longtermmindset.co/investing and let me know where to send it. So now you know a little bit about the history. Let's review and compare these three indexes side by side. So the Dow Jones is the oldest index, starting in 1896, whereas the NASDAQ is the newest, and it started in 1971. The Dow has the fewest number of companies at just 30, the S&P 500 has 500, and the NASDAQ tracks more than 3,000 companies. The Dow is what's known as a price weight index, while both the S&P 500 and NASDAQ are market cap weight index. The Dow tends to focus on big, large cap companies. The S&P 500 also includes large companies, but has a more broad look at the entire market. And the NASDAQ tends to list companies that are technology focused and growth focused. Companies on the Dow tend to be more mature, whereas companies on the NASDAQ tend to be newer and more innovative. Now, because of these differences, the Dow tends to be a less volatile index than the NASDAQ, which tends to have much higher volatility day to day. And these differences attract different types of investors. If you're focused on stability and dividends, you're probably interested in the Dow. If you're focused on growth and innovation, you're probably focused on the NASDAQ. And despite their differences, all three are still heavily referenced in the news today, given that they have slightly different focuses. Now, these differences aren't just trivia. They actually lead to very different results. When tech stocks soar, the NASDAQ often outperforms because it's packed with technology companies. In contrast, the S&P 500 tends to move more smoothly because it's spread across all sectors. The Dow tends to be steadier in more turbulent times, but slower to reflect new industries and new innovations. So which one does better at any given time depends on what part of the market cycle we are in and how the economy is doing along the way. But to show you why these changes matter so greatly, let's take a look at the returns of these three indexes over the last 20 years. From 2005 to 2025, the Dow has compounded at about a 9.9% compound annual growth rate. That produced a total return of about 609%. The S&P 500 produced a total return of 746%, which was a slightly higher compound annual growth rate of about 10.9%. The NASDAQ blew both of those two indexes away, producing a total return of 1,823%. That was a compound annual return of 15.2%. Now, to show you what these differences mean in actual dollars, assume you invested $10,000 in each of these indexes in 2005. The Dow would have grown that $10,000 into only $70,000 by 2025, but the NASDAQ Composite would have grown it into $191,000. That's just shy of a 3x difference in total return, which shows why knowing the differences between these three indices is so important. This is why the news often reports on all three indexes, because each index serves a different purpose for investors. The Dow is often used in headlines as a quick read on economic health, even though it's not the full market. That's because it's the oldest and most well-known index. The S&P 500 is the gold standard for measuring the performance of U.S. stocks, and it's the main benchmark that most fund managers use. The NASDAQ is the go-go growth index for tracking the tech sector and high-growth companies, and often has much higher or lower daily returns than the other two indexes. So knowing which index you're looking at helps you to understand what the numbers actually mean. Now, there's a few big myths about these indices that are worth busting. First, people often think that the Dow is the market. It's not. It's only 30 companies. Second, a lot of investors don't realize that the Dow is a price weight index. So the stock price of companies, not the size of companies themselves, is what drives the Dow's returns. And then third, some companies like Apple or Microsoft are actually in all three indexes. And their impact on each individual index isn't the same because each index weighs those stocks differently. Now, I know that can be confusing, so let me explain to you this way. The US stock market has two primary stock exchanges, the NASDAQ and the New York Stock Exchange. Now, companies list on either the New York Stock Exchange or the NASDAQ, and the three major indices, the Dow, S&P 500, and NASDAQ, can pull stocks from either the New York Stock Exchange, the NASDAQ composite, or both. So, which index is best? Well, each one tells a different part of the market story. The Dow is the better choice for more conservative investors who are willing to accept lower returns in exchange for a smoother ride and higher dividends. The S&P 500 gives a broad view of the entire stock market and is a great choice for investors who want to benefit from the long-term gains of the stock market. And the NASDAQ is the right choice for high-flying growth investors who want much higher long-term returns in exchange for more volatility along the way. The key with all these indexes is to know what you're looking at and what the differences are between them. So that way you won't be confused again. So the next time you're reading headline shouts about the market and the market moves, hopefully this video explains exactly what those news reporters are talking about. Now, as a reminder, if you're a visual learner, I created a free infographic ebook that contains 10 of my most popular investing visuals of all time. If you want a free copy of that ebook, just visit longtermmindset.co/investing or click the link in the video description and I'll send it to you right away. Well, thanks so much for watching. I hope you enjoyed this video. If you did, give it a thumbs up. That really helps us out on YouTube. And if you want to keep learning from here, I highly recommend you watch this video next.